Over the past few decades, Apple stock has made a lot of people very, very wealthy. And the past year has been really good for the stock as well. If we look here, they're up about 25.34%. And if we look year to date, currently up around 28.9%. But as I start to look at more financial headlines, I'm seeing a lot of people start to argue that now could be a good time to sell Apple. Now, this isn't the first time I've heard this. For example, actually when I started buying Apple stock for myself, I was buying shares anywhere from around $120 to around $150 per share. And we can see for the majority of that time, it was during 2022. You can see in 2022 to start, the stock was trading as high as around $172 per share, and looks like it got as low as around $130 to $125 per share. So my average purchase price was around $139. And if we look at my growth on that position, obviously it's done really well since then. I'm currently up about 80%. And again, what I'm trying to say is a lot of people at that time felt the stock was overvalued. Now, here's what's interesting. If we jump over to my stock screener and come up here and plug in Apple, all this data will load in. And like always, if you'd like to be able to download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But what I want to point out on the stock screener is if we look at 2022, earnings per share for Apple came in at about $6.15. So okay, $6.15 in earnings per share in 2022, and the stock traded anywhere from around $125 to around $170. And if we jump over to my Bogle's valuation sheet, we can see for the majority of 22, the price to earnings ratio was sitting at about 24. So that seems like a decent price for a company like Apple. I mean, we're talking about one of the companies that's way outperformed the market for multiple decades now. And for most of the past decade, it's been one of the largest companies in the entire world. And keep in mind, this is the largest position in Warren Buffett's portfolio. So we can see since 2022, since the 2022 low of about $125 per share, the stock has pretty much doubled up to almost $250 per share. So most people's initial inclination would be, well, this company must have grown their earnings by quite a bit during that time. But if we look at their earnings per share in 2024, it's sitting at $6.11, which is even lower than the earnings in 2022. So this stock has doubled in 2 years, but their earnings per share has actually slightly declined. Now, if you've been watching the channel for a while, you know sometimes earnings can be manipulated by management through different accounting methods, so we also need to look at free cash flow per share, but we can see nearly the exact same thing is true. Free cash flow per share in 2022 was $6.87, and it was a little bit higher in 2024, $7.09, but either way, that's not a lot of growth. So what has been going on with Apple stock over the past few years? We're talking about a stock that nearly doubled without growing its earnings per share. So let's start digging into it. Now, to start off, I want to talk about Warren Buffett for just a moment. And we all know this has been the largest position in his portfolio for a while now, but we've seen him sell off Apple stock for multiple consecutive quarters. Let's start in Q1 of 2024. Come down here, we can see he reduced his Apple position by about 12.83%. That's a pretty big reduction in his biggest position. If we look at his position in Q2 of 2024, come down here, Apple, he reduced it by 49.3%. And if we look at the most recent quarter, he reduced his Apple position again by about 25%. So we're talking about massive reductions in his position in Apple for 3 quarters in a row now. And while he has been asked why he's done this, in my personal opinion, I don't think he's given very straightforward answers. Now, if we jump over to my dividend breakdown sheet, let's just quickly look at Apple from a dividend perspective. Now, like you already know, Apple has a very low starting dividend yield, currently sitting at about 0.4%, which has obviously been pushed lower because of the huge share price run up over the past year. And while the company does have a history of increasing dividends, they actually don't focus on increasing it at a very high rate. The 5-year dividend CAGR is only about 4%, and the 10-year sitting closer to about 7%, but they do use very little of their free cash flow to pay out dividends. For example, in 2024, the free cash flow payout ratio was only 14%. But what a lot of people miss about this company is it's more of a shareholder yield company. Now, what does that mean? Well, again, we have to remember there's 5 different things a company can do with free cash flow. 1, reinvest back into the business, which tech stocks like Apple do pretty heavily through research and development. 2, they can pay down debt. 3, they can attempt mergers and acquisitions, but then they can also pay out dividends and buy back shares. And those last 2 are ways to directly reward shareholders, which makes them known as shareholder yield when you combine them. So for example, if we jump over to Bogle's valuation over here, we can see we have shareholder yield. This is just going to be the dividend yield plus the buyback yield. And what we already know for Apple is the dividend yield is sitting at about 0.4%. And then the buyback yield is going to be what percentage of their outstanding shares are they currently buying back. So if we look at the history for Apple, they do have a history of buying back shares pretty heavily. For example, from 2019 to 2020, they bought back over 6% of their outstanding shares, and it's been a relatively high amount since then as well. Now it has gone down a little bit, but the average buyback yield for this company over the past few years is about 3.6%. That's buying back a lot of shares. So even if we assume slightly below that average buyback yield of about 3%, you can see you'd get a shareholder yield of about 3.4%. Again, that's just combining dividend yield and buyback yield. So Apple has a huge focus on buying back their stock, which I think has actually paid off for the company. If we jump back over to the stock screener, look at the rapid share buybacks over the past decade. In 2014, they were sitting at about $24.3 billion, and at the end of 2024, all the way down to about $15.3 billion. Now, this is where things actually get really interesting because yes, we do like share buybacks when they're done properly, when the company is buying back their own stock at undervalued prices. But because it also reduces the shares outstanding, all the per share metrics are going to look a little bit better. So for example, if a company's buying back stock, it's going to help boost earnings per share because there's less shares outstanding. So again, this is where things get interesting. Let me show you what I mean. If we jump over to our profitability sheet, come over here and look at revenue for Apple in 2022. It was about $394 billion, but look at what it was in 2023, $383 million. So from 2022 to 2023, revenue actually declined. But if we look at revenue on a per share basis in 2022, it was sitting at $24.32, but in 2023, $24.34. So revenue per share actually increased when organic revenue for the company actually decreased. So you can see why buying back shares can make per share metrics look quite a bit better. So I like seeing growth in the per share metrics. I'm not against share buybacks. When done properly, they can be a great way to reward shareholders. But if you only pay attention to per share metrics like revenue per share, it can make you miss some major red flags for some company. For example, revenue for Apple has been pretty stagnant over the past 3 years. Again, 2022 it was sitting at $394 billion, and in 2024, it still wasn't up to that amount. It was still below that number at $391 billion. So 2 years in a row now where revenue was below where it was in 2022. If we look at earnings per share, we can see the same thing. It's been pretty stagnant. But again, we're looking at it on a per share basis right here. What if we just looked at pure net income? What does that look like? Well, if we come down here, we can actually do that. Here's our net income right here. We can see in 2022 net income $99.8 billion, in 2023 $96.9 billion, and in 2024 $93.7 billion. So we have 2 years in a row now where net income was lower than its previous year. And this is where people are starting to get concerned because keep in mind, revenue's slowed down over the past few years and so has the bottom lines with net income, but despite this, we've seen the company double its share price. Now, to be fair, the bright spot right here is we can see the gross profit ratio has been increasing with a 10-year average gross profit ratio of about 40.5 and last year sitting at about 46.2. So that's definitely a bright spot for the company. But the reality is because revenue's slowing down, net income is still not as high as it was just a few years ago. In fact, 2024 net income isn't even as high as it was in 2021. But despite the slowdown in growth, one of the things we can see is if we look at our quarterly data, research and development expenses, Apple's still heavily reinvesting for future growth. But if you're heavily reinvesting back into the business and revenue isn't growing, that's not going to be good for the company. It's going to be very bad. Now, I'm not saying continuing to up R&D expense is a bad idea, but we're definitely going to need to see some payoff over the next few years, or else I think people are going to become very concerned about this company. Now, up to this point, I do have to admit, it sounds like I've been pretty critical of Apple. Right now, looking at the underlying fundamentals, you can find some problems with the company. But I do want to be clear, obviously, Apple has some phenomenal competitive advantages. I mean, they have very strong brand and customer loyalty, an integrated ecosystem, and overall, what I would call a great user experience. But does that justify a double in the company's share price when revenue and earnings haven't done anything but decline over the past few years? So if we start to break down revenue just a little bit more, if we look at revenue by segment up to 2023, obviously we can see iPhone for quite some time now has been the majority of Apple's revenue, but even that has slowed down over the past few years. Really, the main increase in revenue for the company over the past few years has actually come from services. You could almost argue that some of this is considered recurring revenue because, for example, some people are always going to upgrade to the newest iPhone release. Or when their iPhone becomes older and starts slowing down, they're going to upgrade to the newest iPhone. But even then, they're still not seeing the growth that they're used to seeing. So with the double in the share price over the past few years and earnings remaining relatively flat, this puts them at a forward price to earnings multiple of about 33.54. Let's compare this to the 5-year average. This is where things get interesting. If we look at the forward price to earnings multiple non-GAAP, that means non-generally accepted accounting principles, we can see again, this is sitting at 33.54, while the 5-year average is sitting at just 27.99. That's about a 20% difference from the 5-year average. If we look at it for the trailing 12 months, we're looking at about a 25% difference to the 5-year average. So right now you have to pay about 25% more for each dollar of earnings than the 5-year average. Now let's jump over to my free cash flow sheet and look at some more valuation metrics. Now, first off, before we look at these valuation metrics, I want to point out the 3-year free cash flow CAGR. It's now only sitting at 5.39%, and obviously on a per share basis, it looks quite a bit better because of the share buybacks, but organic free cash flow has only grown at about 5.4% over the past 3 years. Now, if we look at the valuation metrics, everything does point to Apple being overvalued compared to how the company has historically traded. Look at the free cash flow yield, 2.9%, while the 10-year average is about 6.1%. Price to free cash flow ratio, currently sitting at 34.4, while the 10-year average is 20.5. EV to free cash flow, 35, while the 10-year average is 21.6. Again, all three of these metrics compared to the 10-year average point to the company being overvalued. And finally, if we jump over to my stock screener, let's go ahead and come up here and plug in Apple. And the main valuations I want to focus on are going to be our discounted cash flow and the multiples. If we go ahead and zoom in, again, discounted cash flow analysis, we're valuing the company based on how much free cash flow they're projected to produce in the future. And in this scenario, I'm projecting a free cash flow growth rate of about 9%, a little bit below that average growth rate. Now, obviously, like we just pointed out, it's been quite a bit lower over the past 3 years, but we can see historically speaking, 9% has been pretty close to the average. But applying a 9% free cash flow growth rate to the future free cash flows, finding the present value of those future free cash flows and adding them together, then adding their cash and cash equivalents, subtracting out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of about $163.11. That's dramatically lower than the current share price. Now, if we look at the multiples valuation, what we're doing is we're seeing how the market is valuing companies that are similar in structure. For example, some other big 7 companies. We have Microsoft, Google, Meta, Amazon. These companies have price to earnings multiples ranging anywhere as high as 47.6 to as low as about 25.1. If you look at the average, it's sitting at about 34.46. If we applied this exact same average price to earnings multiple to Apple's earnings per share, we'd come to an intrinsic value of close to $210, which again is lower than their current trading price. Then finally, like we've already touched on, if we look at the historical valuation for this company, what we can see is compared to how the company's historically traded, its current valuation is quite a bit higher than the average over the last 10 years. So if we look at the output tab here and look at the two valuations that we looked at, multiples and DCF, and average them together, we come to an intrinsic value of about $186.51 per share. Current share price about $248. That's a 33% difference. So with a 10% margin of safety, the acceptable buy price would be about $167.86, giving us a sell signal. Now, before we go forward, I do have to mention, this is undoubtedly a company that often trades at a premium, probably always trades at a premium. And anytime you get a chance to buy a very high quality company that trades at a premium and buy them at their intrinsic value, that's usually a pretty good opportunity. And usually you can tell whether or not a company is quality by looking at the return on invested capital. And for example, if we look at Apple, return on invested capital is extremely high. It's been above 50% for 4 consecutive years. This is probably the biggest bright spot for this company. So yes, it does undoubtedly deserve to trade at a premium, but does it deserve a premium of about 33%? So again, Apple is a stock that I own in my portfolio. Like I already pointed out, it's done really well. I'm currently up about 80% on this position. So what am I doing with my Apple shares? And this is actually something I've thought about pretty often lately, but I'm actually planning on holding on to my shares. And this is even though I think the company is currently overvalued. So let me explain. There's a famous Charlie Munger quote that states, if you invest in a business that can compound high returns on invested capital, again, ROIC, what we just looked at, then you will likely outperform even if you overpay. If we come down here, we can see an example that he gives. If a business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result. And I actually made an in-depth video on this. I'll put a link in the comments, but you should definitely check that out if you want to understand how that's the case. Now listen closely to what I'm about to say. Valuation is still extremely important. Again, I think Apple's probably a little overvalued at its current prices. Every company goes through periods of overvaluation and undervaluation. And because I'm a long-term investor and I believe this is a high-quality company, I'm not going to try to time the market and constantly jump in and jump out when I believe the company's either overvalued or undervalued. And by looking at Bogle's valuation, we can see a great example of this even if the company starts to be valued at a lower price to earnings multiple. If we come over to Bogle's valuation, we've already plugged in Apple. Let's say the company only has about 7% earnings growth moving forward every single year. Let's say over the next decade, Apple only grows earnings at about 6.5%. We've already touched on the fact they have a shareholder yield of about 3.4%. And even over the next decade, If the company's multiple declines by 20% or about 2% every single year, you could still look at an expected return of about 8% on an annual basis. So yes, at current prices, I think Apple is a little overvalued, but I think you could also argue that most of the market right now is trading at a higher multiple than it typically does. So I'd be interested to hear what you think of Apple stock right now at its current prices, if you're buying or selling. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.